Oil is racing toward $100, tech just suffered its sharpest shakeout of the year, and rate hikes are back on the table. All of that is forcing a rapid rethink of equity risk. You're watching vTalkInsight, Equity Pulse Daily for June 9th, 2026. Let's get straight into what this backdrop really means for stocks. The macro picture has shifted toward a tougher mix of stronger growth and stickier inflation, and that is driving a broad repricing in rates. Recent U.S. jobs data have been very robust, and inflation is expected to run above 4% year over year, especially with oil back in the high 90s. That combination is pulling markets away from the old narrative of imminent rate cuts and toward the idea that the Federal Reserve may still need to tighten further. Pricing now implies a high probability of at least one hike by year-end, and some see the 10-year Treasury yield as having room to approach 5% if this trend persists. We are already seeing the impact in bond markets. 2-year Treasury yields sit well above the Fed funds rate. The 10-year has pushed beyond 4.5%, and the 30-year remains north of 5%. That tells you markets are demanding more compensation for inflation and policy uncertainty. Globally, the direction is similar. Central banks, from the European Central Bank to others, have been nudging guidance in a more restrictive direction, and forecasts for policy rates have been revised higher across a large set of countries. The term premium on long-dated bonds has risen from its post-pandemic lows, reflecting an end to the era of abundant central bank liquidity and ultra-stable inflation. Layered on top of that is a genuine energy shock. Escalating conflict between Israel and Iran, drone interceptions, and Houthi threats to Red Sea shipping have pushed Brent crude near $98 a barrel, with prompt contracts jumping more than 4% in a day. Some scenarios now being discussed involve oil spiking toward $125 to $150 if Gulf infrastructure is hit or shipping is severely disrupted. In that world, headline inflation would move higher again and could bleed into core inflation over the next 6 to 12 months, raising the risk of a stagflation-style backdrop and forcing central banks to lean even more hawkish. At the same time, the macro story is not all bearish. The global economy has been surprisingly resilient, helped by adaptability to shocks and very large investment in AI and other productivity-enhancing technologies. Recession probabilities have actually come down this year, and real growth is still running comfortably positive. Financial conditions, while tighter than a year ago, are not yet biting hard. Credit spreads in investment-grade and high-yield debt remain near historically tight levels, and equity and debt capital markets issuance is strong. The base case from many macro desks remains an extended Fed pause with a high bar for additional hikes, but the distribution of outcomes is widening, and that matters for how equities are priced. Against that backdrop, the equity tape has turned far more volatile. The S&P 500 just logged its largest single-day decline of the year, snapping a long winning streak, while the Nasdaq fell more than 4% in a tech-led sell-off. That weakness did not stay contained to the U.S. Asian markets, saw their largest intraday loss since March, with tech-heavy indices in Japan and Taiwan down more than 3%, and South Korea's Kospi dropping over 8% at one point, triggering temporary trading halts. Chip makers Samsung and SK Hynix fell more than 7%, underscoring just how crowded the positioning had become. For now, some of the immediate stress has eased. After that sharp downdraft, the S&P 500 has managed a modest rebound, and the volatility index has slipped back from the low 20s into the high teens. That points to tentative stabilization rather than an outright capitulation. Even so, several desks warn that the recent decline may not be complete in the very short term. Failed dip buying attempts, heavy exposure in leveraged products, and lingering uncertainty around oil and inflation suggest that rallies could be fragile until the next round of data clarifies the policy path. Stepping back, the broader equity story still looks like a bull market under pressure rather than the start of a full bear phase. Earnings expectations for the S&P 500 point to around 17% growth. Valuations sit near 21 times earnings, and some strategists have raised their index targets on the back of that profit outlook. Market breadth has also improved versus earlier in the year. Small caps in the Russell 2000 have been outperforming the S&P 500, and equal weight indices are keeping pace with cap weight versions. There is also an estimated $7 trillion of cash on the sidelines, which could support risk assets, although the hurdle rate for deploying that cash rises as bond yields move higher. The most intense action remains in AI-linked technology and semiconductors. After a huge run in which semiconductor indices climbed roughly 75% year-to-date, technical measures showed extremes, with some benchmarks trading more than 70 to 100% above their 200-day moving averages. That froth set the stage for a violent shakeout. The Philadelphia Semiconductor Index dropped about 10% in one session before rebounding more than 6% the next day, and Korean chip names saw similar swings. Those moves highlight how crowded the trade had become, but they also show persistent dip buying appetite in the AI hardware complex. Fundamentally, the earnings story is still powerful. Semiconductor sector profits have surged more than 50% since January, and technology earnings excluding the very largest firms are growing at around 50% year-on-year, the fastest pace since the global financial crisis. In some cases, share prices have not fully kept up, leaving valuations for leaders like Nvidia, Broadcom, and Micron at or even below the broader market multiple. Elsewhere in the space, however, valuations have re-rated aggressively. Forward multiples for some semiconductor groups have jumped from about 17 times to 28 times, suggesting that the easy, valuation-driven gains are behind us, and that future upside will have to be earned through continued earnings delivery. At the same time, there is a widening gap between accounting earnings and free cash flow at several large tech and chip companies, with firms such as Meta reportedly considering equity raises to fund elevated capital spending. What is driving that tension is the sheer scale of the AI infrastructure build-out. Hyperscalers and AI specialists are struggling to secure enough compute capacity, and demand for advanced chips is outpacing supply. Unlike past cycles, capacity additions are more disciplined and concentrated among a handful of leading-edge manufacturers, which supports pricing and margins. At the same time, the tech sector is shifting from asset-light to asset-intensive. Companies like Google, Meta, and Microsoft are committing enormous capital to AI data centers, networking, and power. SpaceX itself is seeing capital expenditure rise to more than twice its revenue as it pushes into AI-related infrastructure, raising questions about how sustainable that pace is and who ultimately captures the economic rents from AI. The AI narrative is also maturing. Generative AI and large language models are becoming more commoditized, with open-source alternatives, particularly some Chinese models, reportedly as much as 50 times cheaper than frontier systems for routine workloads. That cost gap is encouraging enterprises to focus on targeted, high-return use cases rather than broad experimentation. As AI service providers move toward charging closer to the true cost of token usage, demand growth may become more selective. The emphasis is shifting from raw usage metrics to pricing power and integration into core workflows that genuinely move the profit and loss. That is creating a split market, especially in software, between perceived AI beneficiaries and AI victims. Company-specific developments underline how dynamic this landscape is. Intel shares have surged after reports that Google plans to source more than 3 million custom AI chips from Intel starting in 2028, a major win for Intel's foundry ambitions and a sign that hyperscalers are diversifying away from single-source manufacturing. Apple, meanwhile, is leaning on Alphabet's Gemini models to accelerate its AI roadmap. The latest worldwide developers conference brought announcements around a revamped Siri and deeper AI integration, but the market reaction was lukewarm. Apple stock reversed lower on a classic sell-the-news move, partly because the new features are initially limited to the latest high-end devices and failed to exceed already elevated expectations, even though Apple remains one of the better-performing megacaps this year. Beyond day-to-day trading, the structure of equity supply is changing quickly. Equity capital markets activity is up roughly 65% quarter to date, and large U.S. banks are reporting strong deal flow across equity, advisory, and debt capital markets. Record levels of new issuance are now hitting both stock and bond markets. Major tech names such as Alphabet and potentially Meta are tapping equity markets, and there is growing concern that the shift from net buybacks to net issuance could test market absorption capacity, especially if risk appetite softens at the wrong moment. The focal point is the upcoming SpaceX initial public offering. With an estimated $75 billion valuation and a float of only about 4%, demand already exceeds the available shares, especially from retail investors who may account for close to 30% of the book. Estimates suggest retail demand could reach $50 billion, and that money has to come from somewhere. U.S. equity and semiconductor-focused leveraged exchange-traded funds now hold around $175 billion in assets, and reallocations out of those vehicles and out of recent tech winners to fund SpaceX participation could amplify volatility around the deal. There is also an intense debate about what SpaceX symbolizes. Institutional investors are increasingly cautious, with some treating the deal as a potential sign of a market top, and there is broad agreement that the implied valuation looks extremely rich relative to conventional metrics. At the same time, history suggests that large, high-profile IPOs do not automatically mark the end of bull markets. Strong buybacks, mergers and acquisitions, and still solid consumer demand could help offset the flood of new equity. What seems clearer is that scarcity premia in some crowded tech names are likely to erode as more capital-intensive AI and space infrastructure stories come to market, forcing more discrimination between growth narratives. The energy shock is creating very different realities across sectors. With West Texas Intermediate and Brent crude both trading above $91 a barrel and geopolitical risks still elevated, energy producers remain supported, and this is seen as an important cushion for markets like the UK, where oil-exposed stocks carry significant index weight. For energy consumers, the picture is much tougher. Airlines are experiencing a classic margin squeeze as jet fuel costs surge. Industry profit forecasts have been cut roughly in half, from over $40 billion to just above $20 billion, and management teams are openly discussing fare increases to preserve profitability. Executives warn that if fuel prices remain this high into the autumn, survival risks will rise for weaker, thinly capitalized carriers. Smaller airlines with stretched balance sheets are most at risk of distress or forced consolidation, while stronger players are already moving to acquire valuable routes and aircraft delivery slots. Airbus is signaling further delivery delays due to supply chain bottlenecks, while Boeing has been improving output from a low base. That scarcity of new aircraft gives larger, better capitalized airlines another competitive edge, especially in Europe, where fuel hedging practices and more fragile demand make the sector more vulnerable than in the United States. In Europe's financials, consolidation rather than distress is the dominant theme. Intesa Sanpaolo has launched a €30.6 billion bid for Monte dei Paschi, a move that would give it control of valuable assets including stakes in Assicurazioni Generali and Mediobanca, and could reshape the Italian banking landscape. Banco BPM has floated a competing merger idea but without a formal offer so far, leaving Intesa as the clear frontrunner. In French telecoms, a consortium of carriers is working on a plan to split SFR and reduce the number of mobile operators from 4 to 3. The goal is greater pricing power and more capacity to invest in 5G networks and data centers. Both stories highlight how higher rates and rising capital intensity are encouraging scale plays and sector consolidation, with implications for competition, margins, and ultimately equity valuations. Putting it all together, equities are now trading at the intersection of three forces: a resilient growth backdrop with strong earnings, a credible threat of higher for longer interest rates, and an energy shock driven by geopolitics. Tech and AI remain the structural growth engine, but leadership is broadening and the cost of capital for that growth is rising. Near term, the key signals to watch are clear. Upcoming U.S. inflation data, further moves in Brent and West Texas Intermediate crude, and any shift in Fed or European Central Bank rhetoric will all feed directly into rate expectations and equity valuations. On the micro side, execution by AI heavyweights, the outcome of the SpaceX IPO, and developments in sectors like airlines and European financials will help indicate whether the market absorbs this new supply and macro uncertainty smoothly or whether volatility needs to reset higher. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.